morning, everyone. Welcome to Coffee with Carl. This morning, I have Brad Neuman. He's a market strategist with Alger Funds. How are you doing today, Brad?
Great. Thanks for having me.
Perfect. So today I want to just go through, talk a little bit about the markets, where you guys see some opportunities, and and on your guys' end, where you guys are targeting, between now and the end of the year, and then certainly into next year. Where we are right now, there's been certainly a lot of talk, and more recently today, you're hearing some investment banks downgrading U.S. stocks. But on your guys' end, are there any big pitfalls that you guys are seeing with the stock market that are really concerning you? And then, as far as opportunities, where do you guys see some big opportunities in the near term and then into next year?
Well, first of all, I think we think about the stock market and investing a little bit differently than at least how the media portrays it, and probably many of our peers. I think if you listen to the media, you'll hear a lot of headlines about which cycle are we in, where are we in the cycle in terms of the monetary cycle, when is the Fed going to tighten or taper, et cetera. The fiscal cycle, when are taxes going to be raised, or how much stimulus is there going to be from government. So those kinds of, cycles, I think people are very focused on. For us, we're looking at kind of a much broader cycle, these technological revolutions that we think come along every several decades. And we think one just ended a few years ago, and we think we're in a new one. So the one that just ended, the age of telecommunications, was kind of started with the big bang of the introduction of the microprocessor in the 70s, and introduced personal computers to white collar workers all over the world, and ultimately brought us smartphones and the power to look at all of human knowledge just in your pocket at all times. And today, we think that that revolution is relatively mature. PCs aren't growing, smartphones generally aren't growing globally. But we think that there's a new technological revolution that we're really excited about, called the age of connected intelligence, where smart computing will be pervasive all around us and help us basically make better sense out of all the data that's being collected through basically the Internet of Things, whether you have a wearable device on your body, or in your car, or in your home. All of this data, trying to make sense of it, we need this kind of connected intelligence to be able to make better decisions in our personal and business lives. And so we're less focused on where we are in those monetary and fiscal cycles, and much more focused on where we are in this technological cycle. And we see great opportunity over the next decade, as this is, to us, the most innovative period in human history.
What I guess more granularly, what type of themes within that are you guys targeting, and within that kind of growth space?
Gosh, there's a lot. So semiconductors is a pretty big place for investment for us. I would say there's a couple of notable drivers to that theme. One I just mentioned is the Internet of Things. So as there's more smart devices, that smartness has to be driven by semiconductors. And so the companies that manufacture those semiconductors, and the people who make the equipment to help manufacture those semiconductors, we think that'll be in demand. Also, more recently, you've seen with COVID and supply chain disruptions, there's a lot of countries and industries that can't get access to semiconductors right now. Of course, it's holding up the supply of manufacturing of automobiles and many other items that are in short supply. And so I think you're kind of seeing a change in the supply chain from going for the best efficiency to having strong resilience, meaning that companies and countries want access to the critical components of a supply chain. And there's nothing more critical than semiconductors. And so I think as you see China start to build out its semiconductor supply chain, and other countries and companies more focused on having access to that supply, that's the second driver that we see of semiconductor and semiconductor capital equipment. So, we see it as this long-term secular trend.
I guess you mentioned China there. Do you have any concern potentially with us and China and Taiwan and being a massive semiconductor distributor, I guess, as we think, potential geopolitical issues over the next couple of years and how that might play out within the space?
Yeah, well, there's no question China's concerned. China doesn't want to be dependent on the U.S. for its semiconductors, and so that they are trying to come up that learning curve and have their own fabrication facilities. And that's why one of the reasons why we like the companies that manufacture equipment, because of course China can develop its own manufacturing facilities, but they can't really build the equipment that is used in those manufacturing facilities that ultimately produces the chips. And so some of the companies like Applied Materials, those types of semiconductor equipment manufacturing companies, those companies we think really have a good strategic place in this chain. But yeah, certainly U.S.-China relations becoming more and more strained will manifest itself in more redundant supply chains and increased semiconductor fabrication facilities. So that's one theme. I mean, other themes we like, if you want, we can get into genomics, payments, et cetera.
Yeah, I think the payment space has been pretty interesting. You're seeing a big push and from a number of companies around the world. So are there any in particular that you guys are themes as well as companies that you really like in the space?
Well, just to step back a little bit, there's two main drivers to payments. One is e-commerce. Of course, if you're going to buy something on the internet, like many people did during COVID, there was a huge, much bigger increase in e-commerce spending than there typically is. That necessitates not using cash and obviously digital forms of payments. So that's one driver of digital payments. A second driver of digital payments, which is actually going faster and is probably a bigger driver going forward, and one where China, which we just talked about, is far ahead of us, is point of sale. So paying for something in a retail store, not with cash, but with a QR code, like scanning it on your phone, or using near field communication to pay for something wirelessly with your phone. That's the second big driver. So those two big drivers we think will create the digital payments industry, to far outpace global GDP growth. Something like a double-digit percentage annually. And we have investments all throughout the payments ecosystem, whether you're talking about payment processors who do the back end, payment networks like Visa and MasterCard, who help complete the transactions and route them to where they're supposed to be, the actual payment hardware in the case of a company like Square. And then I think these one of the more interesting areas of payments is kind of these software areas that provide payment gateways. These are like the PayPals of the world, who also owns Venmo, of course. These companies, I think, will increasingly capitalize on having a digital wallet, which may, to some degree, be kind of like the be like the new homepage for the new internet. The wallet will give you access to many different applications in the next phase of the internet, or Web 3.0.
So I think one of the challenges that I think about plan participants or just investors in general is they're very short-term focused. And it sounds like a lot of these themes, right, are trends that are going to be on the next 3, 5, 10 year, time horizon, or obviously maybe sooner. How do you guys think about that when you're trying to design these portfolios? Do you ever get concerned about some of these short-term fluctuations when you're, managing these growth strategies, or what are your thoughts on that end?
Yeah, well, we have models that have bull, bear, and base case price targets for 1, 3, and 5 years out, and we're constantly trying to balance the risk in a stock over that short term, the 1 year, whatever that risk return profile is, with the longer term. And that's why we do turn over the portfolios, because the risk rewards in stocks are constantly changing. Even if your view wasn't constantly changing, you had a long-term view and you were really confident who the secular winners would be. And most of the time, we do have that long-term view. Nevertheless, stock prices are always changing. So that's why we constantly need to adjust and trade stocks. And it's not just a buy and hold market. We don't think that works anymore with the velocity in stock prices.
I guess big picture economics, I know this, you're focusing more granularly, but from an inflation standpoint, is that something that really concerns you, or are you more in the camp that innovation is really going to trump a lot of the big inflation that some people are calling for?
Well, kind of both. I think innovation is much more important than inflation. I mean, you look over time, and we live much better than our grandparents did, and they lived better than their grandparents did, and there have been all sorts of different inflation regimes over that time frame. But innovation is really what drives wealth creation and a better standard of living over time. And actually, we think that innovation is accelerating, just like you've seen in Moore's law and in semiconductors and the processor. It's each year chips get faster and faster by not the same amount, but an accelerating pace. So that's the very biggest picture. But I am concerned about inflation. I do think inflation will be higher than most people expect, and of course that has short-term implications. I think there's a couple of drivers to having a higher inflation than I think a lot of folks expect. So right now we're just living through a supply shock, whereas we mentioned before, you can't get certain components. And so the lower, economics 101 teaches you that if supply is reduced and demand stays the same, all else equal, you have higher prices. So that's what we're living through right now. Going forward, I think that we're going to increasingly see wage inflation. It's very hard to find workers, particularly low-skilled workers in many industries. Businesses are complaining about that, saying it's their number one problem. And so I think you're seeing significant wage inflation. That'll take a while to work its way into price inflation, which is what the newspaper headlines are all about. So that's one driver. And the second driver I think you can see is home prices. The way they factor into CPI or government reporting of inflation is kind of odd, but you can see that home prices, property inflation will be with us for at least a year longer, just the way mechanically how it works. So I am concerned about inflation. I think my take on it would be that it's a very different playbook now than the last time we had a big bout of inflation, which was the 1970s. And not that I'm calling for double-digit inflation, I just think it'll be higher than we've had over the past several years. So in the 1970s, the playbook was to buy commodity type companies that produce things where if there was inflation, the thing that they actually sold, say like a gold mining company or some kind of other, oil type business, thing that they actually sold would go up in price. And so the company would earn more in profits. I don't think that should be the playbook for investors today. I think there's a lot of technology-oriented businesses, growth-oriented businesses that weren't around back in those days that are very inflation resistant. What am I talking about? I'm talking about businesses that don't rely on, don't have a lot of materials costs, so they can't get squeezed. Don't have a lot of wage pressure, but also also their revenue will go up with higher prices. And we actually just talked about one type of business here. And that's kind of like the payment networks, for instance, Visa and MasterCard. If prices go up uniformly, say, 5% across the board, then their revenue should go up with that because they simply have a take rate on the top, and they have very little costs against that would squeeze them. Same thing with a marketplace business like Amazon's third-party business or eBay, those types of businesses. As prices rise, so should their revenues, and their costs are not really that large, and so it's likely that their profits would expand. So those are the kind of businesses I think that we should think about in inflation 2.0 in the current higher level of inflation.
Are there, if you were to pick out maybe one or two things that maybe concern you the most, with where we are in the market today, and certainly where we can go over the next few years, is there anything that you really pinpoint now that's really concerning to you outside maybe, potentially higher inflation?
Well, I'll answer that. Let me just take a giant step back. There's only three things that impact returns, stock price returns: starting dividend yield, change in PE, and change in earnings. Those are the only three things. So the dividend yield, you don't have to worry about that. You start off with a 1 to 2% yield in the stock market in general, or depending on what stock, maybe you don't have one or you do have one. Anyway, then you have the change in PE, and that's driven returns over the past decade. We've had a big expansion in PE. Over the past year, though, it's kind of handed off the baton from PE to earnings growth, where we've seen huge, change in earnings, over $200 for the S&P 500 probably in the next 12 months. And so that's a huge change from where we were, a year or two ago. And so that's been driving the stock market higher. PEs are unlikely, price to earnings multiples are unlikely to expand, particularly, we'll talk about some of these concerns I have in a moment, but they're unlikely to expand if interest rates are unlikely to go down further, which is my view. And so you're left just kind of with earnings growth. And so I think that stock market returns will be lower than they have been certainly over, the past year or so, and I think lower than they have been historically. So that's the big picture. The smaller picture, what concerns me is the potential for earnings growth to not be as strong as it has been in the past. And when you talk about what are those factors, I think the top two things on the list there are fiscal and monetary tightening. So monetary tightening, that's the Fed probably beginning to taper here over the next several months, maybe at the end of the year, and then actually raising interest rates maybe sometime next year. That will probably weigh on earnings, although with a lag. So maybe that's more of a 2022, 2023 event. And then you have fiscal tightening, and that's whatever the government does, and the government's trying to pass its budget, and there's going to certainly be higher tax rates in there. There's going to be a higher corporate tax. There's going to be a higher individual income tax. There's going to be higher capital gains taxes. Those things will weigh on corporate earnings and the economy in general. And so those are the two major things that I'm worried about: monetary and fiscal tightening, and I think that will slow earnings growth in 2022 and 2023 from what it was certainly in 2021.
Mm-hmm. When we think about U.S. markets, where do you see the most opportunity, whether it be small, mid, or large U.S. companies, maybe the next year or two?
I still like small cap companies. We've been saying that for past, since we started recovering from COVID. Again, big picture on small caps is they typically generate 100 plus basis points more over the long term than large cap companies. And more recently, they're actually trading at a discount in terms of a PE multiple to large cap companies, which is rare. They typically trade at a premium. So they're kind of attractively valued. They typically do well, in economic recoveries, which I still believe we're in, even though it's a little slower here in the third quarter and probably in the fourth quarter than it was in the second quarter. But that kind of attractive valuation and faster growth, I think that makes small caps more attractive than large caps.
What about looking at the international markets versus U.S.? You guys seeing more opportunity over there, or still more domestically?
So the portfolio managers domestically, internationally, both are they're optimistic about their portfolios. But I would say for me personally, I think there's a little more opportunity outside of the U.S. than there is inside of the U.S. If you think about the U.S., done a fantastic job relative to the rest of the world in addressing COVID, getting vaccinations, particularly in fiscal stimulus, and supporting folks in our country relative to what we've seen in Asia and Europe. And so now, you're getting closer to the payback period of that. We mentioned fiscal and monetary tightening, having to pay for some of that huge, budget deficit of $3 trillion. And so as that tightens, you'll see a little bit slower growth in the US, but I think they're behind in Europe and Asia, where vaccinations are still ramping up and fiscal tightening is not here yet. And so I think the macro picture may be a little bit better outside of the U.S., but more specifically, I think that there are a lot of really interesting growth companies that are much cheaper outside of the U.S. than they are in the U.S. And whether you look at various themes that we were talking about already. When you look at how they trade in non-U.S. markets versus U.S. markets, you can get exposure to similar types of end market growth, but 25, 50% cheaper in non-U.S. markets than U.S. markets. In fact, if you look at non-U.S., the overall non-U.S. stock market relative to the U.S. stock market, it always typically trades at a discount, but that discount is significantly larger, nearly 2 times as large relative to history. So we like, I like stocks outside of the U.S., particularly growth-oriented businesses, where you can get them for cheaper than you can in the U.S.
That's wonderful. I guess one of the last challenges I've found, and you've hit on it with, right now rates being so low and a lot of the participants on here, is how they manage these 60-40 kind of traditional portfolios. It seems that there's going to be, or a lot of people are going to have to make shifts to potentially add more growth into their models, and get away from some of the fixed income exposure to, deal with the lower growth rates. How are you guys kind of projecting out that, that kind of old thesis of the 60-40 kind of standard retirement portfolio?
Yeah, we've been talking quite a bit about this over the past few months. The 60-40 portfolio has been great over the past couple of decades. Certainly in a declining interest rate environment, bonds are going to give you strong return, and they're relatively uncorrelated or less correlated to stocks, and so that's been wonderful over time for investors, and a lot of people are still in that mindset. Unfortunately, the macroeconomic environment and the level of interest rates matters a lot to the 60-40 type of approach. And so, if you look back in the 70s and early 80s, 60-40 did not work well. Bonds had worse risk return, or Sharpe ratio than stocks did. And so adding bonds to your portfolio really wasn't helpful. And so the question is, going forward, are we going to be in an environment that's more akin to the 70s, early 80s, where interest rates weren't falling or were rising? And, or are we going to be, in something like the 90s or 2000s, where interest rates were falling? And, we don't think interest rates will probably fall more from here. We think correlations are rising between bonds and stocks. And so the 60-40 portfolio is not nearly as good as it was before. And so that leaves you with the question of, what to do. So we do think stock allocations should probably be higher than they have otherwise been, bond allocations lower. But what do you replace the bond allocation with? Well, to some extent, it's a little bit higher cash probably, or things like cash, but that's not a great investment because we all know that cash loses value over time. The money supply grew 25%. During the COVID time period, we added $4 trillion to the money supply. It's still growing 12% right now. And so, you don't really want to hold something where the government's printing a double-digit amount of it each year. So what can you do? There's hybrid asset classes. These are things like convertible bonds that give you, a little bit of equity exposure with a little less risk. There's also, long short types of equity funds that give you a little less beta than the full stock market. So those are kind of, hybrids. Preferred stocks would be another one. You can even find floating rate preferred stocks, if you're nervous about interest rates. So I think that kind of hybrid class is one class of assets. And then there's an emerging class of assets that I think investors are still trying to grapple with understanding. These are things like carbon credits, which is increasingly becoming a global market, or cryptocurrencies. So I think those are kind of the areas. Those are the two big buckets from which investors could replace some of their bond portfolio.
And then as we finish up here, Brad, if you were to think about, just to give some of the viewers a just better understanding of Alger and, strategically how you guys invest, if you want to just give them some final thoughts as to your special sauce and, big differentiator on your guys' end compared to potentially some of the other managers out there.
So, at Alger, we've been on the leading edge of growth and change since 1964. The firm was started by Fred Alger, who was one of the pioneers in growth investing. And so we think that we have this philosophy that's withstood the test of time. And, I think there's two kind of special things about Alger. One is the philosophy, which tells us to pursue change. And change begets higher stock prices, companies that are on the right end of change. And so we really think that fishing in the right pond is a big part of finding, getting strong returns for our investors. The second piece is our process, which has, been proven over the decades that it really is grounded in proprietary research. That's where we're, not just talking to sell-side equity research who are covering the companies or the companies themselves, but we're actually talking to companies that compete with a prospective company, companies that sell to the company that we're looking at, suppliers, competitors, ex-employees, consultants, everyone kind of on the ground within the industry, really getting into the weeds and trying to figure out, whether a new product or service from a company is really value added, and whether that has a lot of growth behind it and should take share from incumbents. And so that's what we do day in and day out. We've got a big research team and a lot of resources to take advantage of that, and we've seen a lot of success over the years. So I think that's what makes Alger a special place.
Yeah, I certainly can attest to that. And Brad, I do want to thank you for your time today. And then for anyone on the call that has any questions that for myself or would like me to get along to Brad, I'd be glad to forward that along. Thank you so much, Brad.
Yeah, thank you.